We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Henrik Zeberg, macroeconomist, business cycle student, Elliott Wave practitioner, and co-founder of the ZebergReport.com. How are you today, Henrik?
I'm good. Thanks, Tom. Just recovering from COVID, so feeling better every day.
Good to see you're still kicking and that you were able to live through this deadly virus. It's great to have you back to kind of get an update on your views. You, of course, are let's say short-term bearish on gold, and I'm happy to have you back to kind of really explain how you see things unwinding here. So we've got an excellent presentation with lots of slides, so this is best viewed on YouTube, but we'll go through and try and explain everything. And you're saying that winter is here, and the Kondratieff winter that we talked about on the last time we recorded, it's here. So go ahead and explain why this top might be in for a bunch of assets.
Okay, good. So first of all, I think the Kondratieff winter is something that is lasting longer than just the coming time frame that I'm going to discuss here. But so it's something that I see has been going on since 1999. But I think that we're coming to a very important step and a very important phase in the winter. I think we're coming to the final phase, the deflationary phase of it. I've been speaking of that for a long time. I think we spoke back in May, I think, of 2020, and we have just been going through the first part of that deflationary crunch. I think we're going to see the next part play out really soon. I think actually today and this week and the coming weeks will be something that can show us that we are at a major turning point in this winter. And what is it that's happening? It's really about the dollar. So ever since we had the bottom in markets in equities and the top in dollar back in March, we've seen that we have had an inflationary bounce that has been going on due to the fact that, of course, the central banks rose to the challenge and stepped in, and we've seen the dollar decline, and everything has then been jumping up, rallying. We've seen it in cryptos, we've seen it in equities, which have come back from with vengeance over the last 9 months. So, but nothing, you can stimulate you this long, and then at some point the real economy needs to take over. And if it doesn't, you'll not see inflation, you'll see deflation, because the economy is about money starting to circulate, and what we see is not money circulating. We're seeing money stand still. And the coming corona, the second wave and third wave or whatever, and all the mutation and the lockdowns is something that will have an impact on the economy and will probably be the reason why we're going to see another deflationary bust.
So when you're talking about this Kondratieff winter, what are the pieces of this that still need to be experienced here?
So during the Kondratieff winter, we are seeing the whole reason behind it, or the whole the cause of it, is really the amount of debt that you see throughout the economy and in the whole world. And at some point, we know that as a personal experience also, if you have too much debt, you'll not be spending as much, and you'll tell your wife not to spend as much, and that's why they'll see consumption go down. Mm-hmm. And the economy really is about consumption and about investment, and that's really what you see during the winters. And we've had these winters before. I don't want to go through a long history of that today, but really just say that. So what you see is the pressure on markets and on the economy, really on the economy, is what the debt does to the private consumption and to investments, and you'll see that growth levels are coming down. We can check that it's been coming down since 1999, and we are seeing the central banks coming to the rescue, and they think they have the stimulus packets, as Keynes told them, that we need to stimulate the economy, and then you'll see everything come back and you get a positive spiral. But what you're actually doing by supplying money to the market is really and lowering the yield levels, the interest levels, is really that you are giving people an incentive to take on more debt. And that's why, and countries to take on more debt. So you're actually adding to the problem. And that's why you will not see a solution to the Kondratieff winter before you actually get that. The last time we saw that was in 1949 and 40s. What we see now is that the central banks are still in this disbelief that they can actually stimulate them back into the business cycle, back into a positive spiral. So what we see now here is we're still going to see some deflationary fallouts. We're still going to see currency crisis. I think there will be currencies that are suffering a lot, and I think there are some out there that we've seen with the Turkish lira and others. And you're going to see, that will be part of the next phase here. I think we're going to see pension fund crisis also. I think there will be pension funds not being able to live up to their promises and the liabilities due to the crash in equities that I expect.
Mm-hmm. So this kind of goes to your point of the fact that the Fed is actually a danger to the market instead of a savior, correct?
Exactly. I think Sven Heinrich was putting that up in a great article, and I pointed to it on my show also. And I think that is this about thinking you're the savior, and then you're actually adding to the problem, and you're blowing up bubbles here that are unbelievable and unprecedented. And this is the problem for the economy right now, because we have to distinguish between what is inflation created in the economy and inflation created in assets. Mm-hmm. And actually, we have a situation right now where the Fed and the rest of the central banks of the world have failed in creating a inflation in assets. They have in the real economy, they have created a bubble in assets. That's what they've done. So the money hasn't started to circulate and do what they wanted to do to make the economy start to run again. The body, so to speak, is dying. They've supplied a lot of blood, but the blood is not circulating the body. And that's what we see right now. We see that the Fed and they've done everything they can in terms of monetary stimulus, but it's not helping to create the inflation they want. What they do not look at is the inflation that they've created in assets. And that's where we see stock markets. That's where we see risk assets all over the world. That's where we see cryptos. That's where we see everything has been going up in value, has been, rallying to extreme heights. And everybody can see that some of it is in bubble territory. And this is what they have created. They created the monsters that when that monster is coming out, or when the inflation is coming out, deflation first is coming out, it's going to be tough, and it's going to be tough for some months before they actually get the inflation, because the inflation will come. I'm not a disbeliever in inflation. That will come, but I'm just not seeing the same path as everybody else seems to see it.
Mm-hmm. So let's talk a little bit about the timeframes of the deflation, and maybe this liquidity crunch, as you were talking about, and then when we could actually see this inflation happen.
Sure. So I'm looking at I'm looking to commodities for an idea of when is inflation coming out, because you'll not see inflation for as long as rubber and steel and whatever have we, wheat are going declining. You're going to see that's deflationary, and that's why I'm of the opinion that you see structures in markets based on the fact that everybody engages as a individual, and I'm trying to do what's best for me, but actually will turn out to become structures in the market, and those are quite visible if we are just looking hard enough. What I see is that the commodities have been in what I call a declining wedge, have been going down since 2009 and actually since 1982, but long story. But have been declining since 2009, and we are seeing now the final phase of that. I'm seeing that the commodities has been bouncing since March, but only bouncing. So many people are calling that was the bottom. It seems like people are already calling for stagflation, which I will also see coming, but I see it as a bounce. And I'm here on the page that you have with the inflation bounce on commodities. I hope you'll put that into the show. Mm-hmm. That what we see is that we had a strong decline in commodities index during the March decline. And then we're seeing this long period of, where prices start to go higher, and everybody's so enthusiastic that, okay, market is going higher, and now inflation is coming, and And what I see is a bounce before the last drop. And the last drop is coming mainly because of the structural things that I see in the market. And I do that across market. And I see a picture of one final major bust, which will be very hard on equities and on commodities and on gold and silver, because what will all be about is liquidity, and liquidity is US dollar.
And as you were saying, it's this structure here, let's say from January of last year of 2020, that's the elevator down, stairs up, and then now you're saying elevator back down, right?
Exactly. And if you zoom out on this chart, you can't do that, Tom, but I got those, of course. But if you zoom out this is on my this is a pinned tweet I have on my Twitter account. Is actually just to show that. I mean, we are in a structural move where, yes, we will see a bounce, but we're going to see the elevator going down, and we're going to and at that time, we're also seeing a market shaping up a structure, equities shaping up a structure of a broadening top, which now is doing a throw over. We are looking at oil, which has been bouncing hard from the negative territory we were back in April, but still bouncing in my book. And the same thing with the dollar. I mean, that everything has been rallying because the dollar has been declining. It's been declining since March. What I see is the dollar coming up strong, very strong from around these levels. And I think the kind of rally that's going to put in is going to crush everything else. Cryptos is a total complete. It's a bubble, as I see it. It's really interesting to see how many people jumping onto that train and not realizing that's only happening because the dollar is weak. If the dollar comes up from here and we see a yield spike also that I've been calling for, and we saw it move up through what I think is a cup and handle kind of pattern. If we see that spike, as I expect, you will see commodities, you'll see gold and silver, and you'll see cryptos coming down really hard, and you'll see the dollar rally. And I see the structure on that. Sorry.
And those two factors of the yield spike and the dollar coming back up are the, let's say, like I was saying, the two main factors against commodities and let's say gold and silver and cryptos, right?
Yeah, it is. It is also about, so it's about the liquidity also. It's about, the fact that there will be governments, there will be corporations, there will be, ordinary people having margin calls if we start to see the crunch. Everything right now is based on credibility of the Fed being able to, to elevate this higher. And if it starts to come down, if it starts to crumble, you'll see margin calls. You see people needing to get out of their positions and be asking for dollars. They'll not be asking for gold at that point. So gold will be crushing down as we see yields moving up, and we see the dollar moving much higher. I think the Dixie for me is above 110. Something 110 would be something easily reached within the next coming months. And we have seen these periods before. We actually saw the back of the deflationary period of 2008, 2009. So if you go back and look at the euro dollar, you'll actually see that kind of decline that we had there is what I expect to be playing out here.
So let's go back to the slides. I'm on the 7th slide here. The stock market is at all-time highs. So explain to us, this setup on the chart that you have here.
Sure. Yeah. What I see here that we of course had a strong rally from 2009, and I think we've had a rally which clearly defines itself in the 5 waves that you would expect in an Elliott wave world. And you also see that the final wave 5 actually shaping up at the broadening top. So there is a sub count, which is the 1, 2, 3, 4, 5 that you see there in that broadening top. And we're doing a shoot over here as we, throw over, it's called. We talk here and we're just above those levels of the trend line. What I expect there is, again, looking to what I see in commodities and on oil and in dollar bottoming out, is it just all comes together right now. It's right there now. We see that the commodities potentially topping out. That's what I see anyway. I see the dollar bottoming out, and I see the stock market at these highs and with extreme valuation levels. And everybody in the market is a genius these days. Everybody who's been putting their money into some risk assets is a genius. I'm one of those stupid guys because I haven't been daring to do so in front of that steamroll. So what I see is that If this is correct, and we see all those, markets coming, aligning them up, aligning themselves against each other. So dollar and commodities and what else have we? The spike in yields, which will be the trigger, which will be the pin that actually burst the bubble. Then I think we're going to see quite a significant decline in equity, and I think the structure tells us that you will have a the kind of decline that we saw in February and March, just much longer. And the Elliott wave tells us clearly that you're going to, in the first wave, to decline to around the bottom of wave 4, which will be around the level that we had back in, and I can hardly see the chart, 2016. So that's around 1,800 in the S&P. And if you see, back in March and February and March, not right now, it sounds like that's crazy talk. I can see that. But I'm trying to follow the structures. I'm trying to follow the logic of what I see if you combine the structures across market. And if you see that kind of, if you were thinking about the kind of fear that we saw in the markets back in February and March, people could easily see us getting out there. We were down at 2,300 at the peak. But right now everybody says, well, the Fed got our back. Guess what? It's air. It's air that's been pushed into this because it has nothing to do with the real economy. The real economy is not better. The real economy, looking at initial claims, looking at whatever you look in the real economy, is not doing great. The average duration of employment is going up, and we see business closing down. We see supply chains getting interrupted. So nothing is great. This is a bubble, and we see that through the valuation levels and whatever have we. And bubbles, when they burst, they are not inflationary. That's deflation. So actually, I have honestly no understanding for the people calling for inflation from these levels. That's might be my ignorance or whatever it is. But I see a deflationary burst first, and then I see inflation. But that comes from the fact that commodities are bottoming out in a major structure going back to 1982. So that's a major structure. But first, and what brings it out is a deflationary birth, so to speak. So that bust will, of course, cause every central banker in the world to come riding to the rescue, and you'll see governments coming in. But the fact is, there is already too much done in that system, and when that money starts to circulate, that's when you're going to see the inflation coming out. That's why explains a longer term perspective on this chart as well. And
to your point there, we need velocity of money to pick up to get that inflation, correct?
Yeah, we do. If you look at that, that's a year-on-year change, money supply and velocity and inflation. And if you look at that, it's really, there are two things in this. There's the amount of money that you print, but it's the speed by which it circulates. And if the circulation goes down, the body dies. And the body dies meaning deflation. So, of course, it's also not good if it circulates too fast. But the thing is, inflation is going down because velocity is going down. And think what we got ahead of us. We got lockdowns. We got lockdowns right now. That was what brought, if you look at the February and March of 2020, we actually saw the decline in velocity. That's why we also had the decline in inflation rate. Of course, we then seen the bounce since then. But if I'm right, and we're about to see that next period of deflation, then it's because the velocity is coming down. It's not because of the money that they printed. That's coming back to bite them, because we're going to have the ketchup bottle effect at some point, for sure. But that's when the commodities start to pick up. And the commodities are not at the structural bottom yet. That's what I see. I think there is this initial bust first. That's what every chart tells me. And then you'll see velocity start to pick up with the amount of money that we have circulating in the system. That's going to be very inflationary. And if we look at the kind of descending wedges that we have on commodity index, they are actually telling us that the outcome of that, when we have the final bottom, is going to be a spike up higher, which tells us that we're going to see a short period of time, 1, 2, 3 years maybe, where we're going to see inflation picking up. But with the things that have been destroyed in the economy, with the disruption of the supply chain, with the people becoming unemployed and all of that disruption, we're not going to see the economy pick up that fast. That means we'll have a period of stagflation. So the stagflationists are right, but they're early.
Once we get this, let's say, deflationary bust and the dollar really starts to pick up, is that going to drive the demand and the let's say drive that monetary velocity because the dollar is going to start appreciating so much and people are going to want to buy things?
No, I think what's going to again, this is where I'm speculating, but it's always like that when you theorize. You have to see what's in the charts, and I think the dollar is going to top out this year. And I might be, again, I've been early to so many things, so maybe I'm early, but I think it's going to be this year, and it's going to be quite a awesome rally we're going to see in the dollar. But what's happening will be, of course, that everybody will be able to see that the stranglehold that the dollar is going to take on the entire world is going to be, it's going to cross growth, it's going to cross everything. So the Fed will think that we need to do something again, and we need to do it big. And now we start to hear that, that governments start to think it's not really a problem how much money we spend. And I think that what they're going to do is that we'll see a major fiscal stimulus coming out. I think that we've seen the stimulus coming out, the talks that we have in the U.S. and the U.S. is leading the rest of the world, but then what comes out there is the most important, the largest importance. And I think they will have to come back at a later point and say, okay, it wasn't enough. We have to do more when you see that bust. And that's going to be, because if you look at it, you have the monetary stimulus and then you have the fiscal stimulus. And I think that change in mindset, which also changed back in '92. I was just a young boy back then, but I remember from my university days that there was a change in mindset that you cannot have debt. Debt is bad. And now you start to hear that the Danish government is talking about that this about not having debt is really not important. That's old thinking. I mean, that's the kind of thing where, that's actually bringing us to the other side of the new economic regime, which will be an inflationary regime. So I think that the money printing, yes, that's one part of it. But the fiscal part of it, I think they're going to bring to it. That's what's going to bring it up. And remember, real economic inflation is not when you see the kind of spikes that you see. That's when too much money starts to circulate and chase too few products. And if you think of it, with the disruption we see in supply chain, we are going to see products. We're going to see everybody's coming out of this Corona winter, or whatever you call it, and say we need to go on vacation. We need to do this and that. We need to spend money and get back, to life. And I think that's what's going to drive the inflation. I think that's kind of stimulus at a time where I don't think it's really needed. But when things start to pick up, you will see that it's going to be either leveraged or extended, or not extended, but there's going to be a much bigger stimulus that is probably needed, and that's going to bring it out. And it's coming, after a deflationary bust. Everybody will get very scared if we see S&P at 1800.
And one of the other, let's say, factors that you kind of take into this analysis is yield curve steepening, and that's typically associated with market tops. So can you give us some perspective at where we are in that yield curve steepening? Sure.
I haven't brought it on the slides that we have there, but what I see is I followed the 10-year yields just to have one of them. I don't need to follow all of them or the whole entire curve. But I think what I see is that we know that the recessions and bear markets come out when you have a tightening of financial conditions, and what you see often is that kind of spike, or if the Fed had been bringing up the rate too high, and then you'll see the market come crashing down, and they made the mistake. That's the ordinary story. The real story is actually that the rate is a lagging indicator. Rates coming is increasing after the economy starts to pick up. So first you will see that the early things in the business cycle is housing, permits, that's leading indicator and others. Then you have something like unemployment going down or up or down is a coincident indicator moving together with GDP. But rates are actually lacking, meaning that the spike we have seen in activity since March is now settling into the rates. So the rates are coming up because it's been going well in the economy for the last 9 months, because if they boosted life into it. But that's actually, a double, a double sorted, anyway. But it's something that's, it's going well. It's something that brings the rates up, and that's going to cross the economy, because you're going to see a lot of things becoming, unattractive as rates come up, and you're going to see the dollar strengthening based on that. And that kind of thinking, I think people may not really understand. Not that you have the economy actually driving rates. It's not just what the Fed. So if rates are coming up, as I see it, and it's spiked up across the neckline of this cup and handle, I think it's going to increase rather much in a situation where you have the economy is not doing well, and you have the stock market at record highs. So that to me is the pin to the bubble.
So what does all this mean for, let's say, take for example silver? You have the chart here. What do we have to look forward to as you see it in the coming months for the precious metals?
Sure. So again, I mean, I called this a long time ago, and the reason I did that was at the lower bottoms than what we had here, and I said that also last time. I know that, and the thing is that, first of all, silver didn't go higher. It went higher, of course, but it has never reached the top of 2011. I'm looking at. Gold did do the cross the line of 2011, but to me, that's really just about a correctional structure, and the reason that is a long one, and we have a report coming out on the Zeberg report where we'll be looking into some opportunities in that. But the thing is that you can have different correctional patterns in a long bull market in gold and silver since 1999 until 2011. You'll have a correction, and that correction can last for some time. Some people tend to believe it stopped in 2015. I think it's still ongoing, even though you saw the top back in August, which passed across 2000. It was at 2070, I think it was around that level in dollars for gold. What I see for gold and silver is same thing. Gold is the one that's been lying. Miners, silver, and platinum have never gone as high as gold, and they are actually telling the true story. We are just in a correction. So I'm not changed my perspective on that. I saw gold moving across, but in the earlier world explanation, that's really just an expanded flat gold, and that expanded flat moved to a high. And since then, we haven't been higher since August. And actually, I don't know what we're at today, but we also see some declines. I think we got major declines ahead. I think we got a bust coming also into, and why? Rates coming up, a strong dollar, and we see the deflationary period. And if you look to 2008 and 9, silver dropped by 60% in that kind of similar period, 60%. So I'm just saying, I see silver below $10. I see gold below $1,000. But those will be the, lifetime opportunities when they get there. It will be about timing.
And I was just going to say, so what kind of timing are you looking for on that? And just to give us an idea of, kind of how long this could take to play out. Sure.
So I think, again, we have to consider that I think silver and gold are actually leading the market in terms of the inflation deflationary market. So if you look at the silver gold, that kind of top to me at around August, same with the miners. And what I see is that sometime during the first half of 2021, this year, we're going to see a bottom in miners and gold. And I feel more certain now than I did back when we talked the last time, because I could see we were in inflationary bounce. But it seems to me we are turning now, and because of the dollar, and we are and that's going to play out really bad for precious metal and the miners. But when will the economy bottom out? That's not the same thing, because that's where we talk about the stagflationary period, and we have a period of the real bottom. So I actually think, and if I look to copper, which is the real indicator of when I see a bottom in the economy, then I look into late 2022 before we get to the real economy bottom. So you'll see. That's why I'm saying that we're going to see a period of time where you have stagflation for a year and a half, which will be fantastic for silver and gold, following the bust. And then you'll see the real economy bottoming out much later, which tells me we're going to have a stagflationary period as well, which will be bad for equity, really bad for equity.
So how long do you think that let's say this next leg lower for precious metals as you see it, how long do you think that could take to play out? And do you, considering timing is so important, where do you think that bottom could kind of be in?
It's timing-wise, before summer.
Okay.
summer this year.
So once we hit that bottom, what are some of the best ways you think, like in your opinion, Henrik, are going to be to profit, to ride that wave back up?
Sure. So everything that has to do with commodities or precious metal will be fantastic to get into. So it's really about just getting in and having a portfolio of commodities and precious metals and miners and whatever that will rally for the next many years. We're looking into. We have a report, as I said, coming out of the gold miners, because I think that will be a fantastic play. We have 15 gold miners that will be coming down to levels that nobody will understand at this moment. But yeah, that's the same thing we saw back in 2008. Well, and when they really bottom out, it's going to come up with a vengeance, and you're going to see, I'll say some things here that people will not think and believe in, but 10, 20, 30 times for some of these miners from the lows that we see will not be unrealistic. Mm-hmm. So, but again, it's about timing. It's about maybe not the day, but the week of the bottom, and that's what we're trying to time here, because really we see a life-changing opportunity here. If you get in, not when it's at 5 or 6, but if you get in at $1 for one particular asset, that's going to make quite a difference. If it goes to $30 by the end of it, if you got in at 1, you got 30 times, and if you get in 5 or 6, it's really about understanding the nature of this. And the thing is, everybody right now who is bullish gold and silver and bullish the miners, and so I've been saying for the last many years, let's get in. Mm-hmm. At least the miners haven't earned enough money. So the last couple of months here, they've been declining quite a lot, and I know that I follow them really close, and I think they are dropping a lot today as well. It's really about timing, and it's really about what is it that I'm looking at, and then you'll be more confident in, okay, now's the time to get in. Now's the time when you see blood in the street. Mm-hmm. And that's where we want to get in. That's what we're trying to aim for. Mm-hmm.
Yeah, and I think the point that you and I talked about last time is worth repeating, that you are a gold bull, but considering timing and with this liquidity crunch that you see coming, you want to get in at the right time, right?
Sure. Yeah, I'm probably the largest gold bull out there. I see gold prices above $15,000. I mean, easily. Mm-hmm. I see the silver above $130 easily. I see that. Just not the time. And the time is that's really the story behind all. So it's very good to be a bull, and it's good to get in on a market that starts to rally. But if you're going to see first a 50% decline, 60% decline in 2008 before you start to see the bull market continue, opportunity lies in actually doing that timing correctly. So I think that's why we got these levels for the particular miners, and we got levels for the commodities that we think are that's where we're heading. And when we get there, we will be very aggressive in getting into the right positions. And I will be I am the greatest bull, but not yet. Mm-hmm.
So one other thing I'd like to kind of get your thoughts on here before we wrap up, and exactly like you were saying with timing, you were calling for a Bitcoin top basically, and for it to start to roll over and crash on January 10th. So give us your thoughts on where Bitcoin is heading, and kind of that time frame as well.
Sure. First of all, I didn't call it at the January 10th only. I called it also at 10,000 or something like that. So I mean, but that just tells me something about the insanity that's going on, and with the everything. Everybody is a genius these days. So you can move into Bitcoin and Dogecoin and whatever, Ethereum, and you have all your own story of why that particular crypto is fantastic. Mm-hmm. And at the same time, we look at Tesla, which is at 1,800 the PE, and we say, this is right because something. And if you look at Cisco back in 2000, which when Heinrich did, and say, well, somebody told us back then that was fantastic, and we saw the kind of PE. I'm just seeing the same thing here. It's the same story all over. We are in an insane bubble, and everybody's telling me the brrr story or whatever it's called. But the thing is, inflation is not coming out. That's what I'm trying to prove. So it's not what is driving it. What's driving it right now is FOMO. And at some point, I think the cryptos will be regulated. I don't know much about cryptos. Honestly, I don't. I see the structures of them. And then I looked to Bitcoin, and I did that structural analysis on it, that where I saw an expanding flat. I realized it's much worse than that. Actually, I think it's a broadening top. That's what I realized on January 10th. It's a broadening top for cryptos, for Bitcoin. Bitcoin, that means actually, and now people will be locking off, but I think it's going to crash completely. So I think something below $1,000 would not surprise me by the end of it. And looking at it also again with the dollar and Bitcoin was declined by 60% back in February and March. I think that was a small bull market, and that was a spike in dollar. If the dollar is going to rally to the DXY is going to 110, cryptos will be annihilated. And I think the reason will be that it's going to be regulated. And of course, no central banker or anybody wants Bitcoin to circulate Bitcoins or any other crypto. And then people tell me, yeah, but they can't they can't stop it. Of course they can. Of course they can. So they will. So what I'm seeing is, yeah, it's been a nice ride for those who understands to ride a bubble. I don't. And that's why I was mistakenly calling it at the top at around whatever it was. People got a lot of opinions around it, and I call that. But I'm saying, take care, guys. If the dollar is going to rally, it's going to bring down Bitcoin. And if it's going to get regulated, it's going to take down Bitcoin. And forget about $500,000.
And just to kind of to wrap everything up like that, the dollar strengthening like this will be bad for not only Bitcoin, but for the precious metals and commodities in general and equities, right?
Yeah, that's what I see, and we see an inverse relationship with all of that and the dollar. And actually, if you look at Bitcoin and dollar for since March, it's straight up, it's right there. And so I think that's why I call it the inflation bounce. It's a bounce in inflation, because silver, gold, and Bitcoin also is an inflationary kind of gauge. And if inflation goes up and the dollar goes down, the risk is coming down on taking on some of these assets, and that's why they have been rallying. But if the dollar starts to move up, the opposite scenario, the opposite environment playing out, and that's why I think it's going to get crushed. And I think it starts very soon, honestly.
Perfect. All right, Henrik. We can find more about you at thezebergreport.com and Henrik Zeberg on Twitter. Do you have any thoughts as we wrap up here?
No, I think it's extraordinary times that we're going through. I mean, it's if getting this right will be actually different. It can be life-changing event for a lot of people. And this about just saying inflation is coming is actually just one side of the story, and it needs to be understood from a more macroeconomic perspective. And the real economy versus the asset inflation is that needs to be understood. And getting that right is what we're trying to do at the Zeberg Report. And let's see what happens the next coming weeks and months.
Perfect. Thanks very much for your time today, Henrik.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.